So my name's Allie Chris with Financial Insights. Wanted to thank you for joining our 5th installment of our Wisdom with Women speaker series, which is a speaker series geared towards professional women speakers sharing educational topics around the areas of mostly finance, a few outliers in there throughout the year. All of our speakers have been fantastic this year so far, and we're very happy to have Amanda Burrows here with us at Financial Insights, certified financial planner, speaking today on charitable and gifting family strategies. And just a little bit about Amanda. Amanda joined the finance industry in 2009, and through her early experiences in the private client sector, she quickly realized it was her career passion. Her greatest satisfaction is financial education and helping clients navigate major life changes. And she's enjoyed assisting her clients throughout all phases of life and serving them as if they were family. She believes the key to a successful client relationship is upholding transparency and confidentiality. She looks forward to working with and serving her South Sound community, and we're very happy to have her here at Financial Insights. She's married to her husband, Richard, and they moved to Gig Harbor after having their daughter in 2018. Although Richard is originally from Tacoma, Amanda was raised in Vancouver and is relatively new to the area. She's been a wonderful addition to our advisory staff here at Financial Insights, and she works as a wealth manager here. We're happy to have you, Amanda, and take it away on your presentation on gifting strategies. And one more thing to add, sorry to interrupt. We will be doing a question and answer towards the end of the session. If you'd like to start writing in your questions as you have them into the chat field, then we will, at the end of the presentation, have an open Q&A session with Amanda. So take it away, Amanda.
Okay, that sounds good. Well, hi, everybody. I'm so glad that you have joined today, and congratulations on being a charitable person, because that's why you're here. At least you have that giving spirit, so that's good to hear. Just a few quotes to kind of get us warmed up. We make a living by what we get. We make a life by what we give. That's a very nice quote by somebody that I don't know who wrote that. Also, when we give cheerfully and accept gratefully, everyone is blessed. That is by Maya Angelou. Now a couple about giving to family. Warren Buffett says, you give them enough so they can do anything, but not enough so they can do nothing. And Farrah Gray says, money doesn't change who you are, it magnifies who you really are. So I think this definitely, I don't know these gentlemen, but I thought their thoughts were interesting when it comes to giving to family. That's always kind of a touchy topic, and it definitely depends on the person receiving the gift, the strategy that we should use. So take that into account. And then I also just wanted to say, there are many ways to give. We're going to talk about money, food, clothing, items, investments, stocks, houses. We're not going to talk about the other ways we can give, which is knowledge, personal skill, and of course our time. So a lot of really valuable ways to give back to charity, to society, to your family, but we're just going to talk about those that have to do with finance. So I first want to say, before you decide to give away all your money, let's do a goals-based financial plan, okay? That should be step number one, I would say. For anyone who wants to start gifting their assets either to charity or family or friends, whoever it might be, definitely talk about goals-based financial planning. Make sure that your money is going to outlive you, that you have enough to get you through everything you want to do in life. And then we talk about gifting, and then of course, dream. Let your financial advisor know what your dream scenario would be when it comes to giving. I would start by making a list of all of your goals. When you decide when or how much to give, definitely rank the importance from 1 to 10. If your goal is retirement, healthcare spending, and giving, giving might be number 3. So rank the importance from 1 to 10 to make sure we can, first meet your basic needs first, and then list and rank potential recipients. And then lastly, know the rules. And that's really what we're going to talk about today. It's just all kind of the rules and regulations around gifting. And hopefully that can kind of build a foundation for you and kind of be a base layer of education so that when you think about gifting in the future, you can kind of think back to this presentation and say, oh, I remember hearing something about this rule. Maybe I should ask my advisor. That's really what I want to do today. And so we're going to talk about gift limitations, gift tax. Yes, there is such a thing. Gifting to minors, gifting for educational purposes. And then of course we have to talk about FAFSA briefly when we talk about that. Charitable giving, gifting appreciated and depreciated assets, and then Roth conversions. We're not going to talk about estate planning today. So really just talk about what we can do while we're alive. Okay, current gift limitations and when they could sunset. The federal estate and gift tax lifetime exemption is currently $11,700,000. Now that's, if you're a couple, you can times that by 2. So each person gets that amount. That is, I'm sorry, I'm very pregnant right now. This child inside me is just kicking my lungs and I can't breathe. Anyway, bear with me, but this is due to sunset December 31st, 2025. So really, we don't know how long we're going to have this lifetime exemption, at least until 2025. But after that, we'll just have to see. So something to note, there's an annual gift tax exclusion, however, of $15,000 per person per recipient. That means that you can give $15,000 to, oh, that means, okay. Where am I? There, that means you can give $15,000 to someone without having to report it against your lifetime exemption. Just keep in mind, if you give more than $15,000 in any one year, you just want to use a special IRS form called Form 709, and no tax is going to be due until you exceed the lifetime exclusion, but it just takes a little extra reporting. So a lot of times it's just really easy. You'll see that $15,000 dollar amount a lot through this presentation because you don't have to report anything to the IRS if it's at that amount or below. And there's no state level gift taxes. So the tax rate, if you go over the 11.7 million, if it's $10,000 over that 11.7, they want 18%, it's 10 to 20, 20%, so on and so forth, until finally, if you give over $1 million above the 11.7 million, that's going to be taxed at 40%. So that's the current gift tax rates to keep in mind. And the annual gift exclusion, I wanted to give you an example of what a couple could do with that $15,000. You can actually gift couple to couple $60,000. Here's how that breaks down. Ron and Cindy have a daughter, Jasmine, who is married to Bill. Ron gives Jasmine $15,000. Ron gives Bill $15,000. Cindy gives Jasmine $15,000. Cindy gives Bill $15,000. So Ron and Cindy can collectively give $60,000, from couple to couple without going above that $15,000 per year per person. So that's just an example I wanted to kind of highlight there. And then gifting between spouses is actually unlimited. So we'll talk about other things that don't fall under the $11.7 million lifetime gift, but if you are a US citizen, gifting between spouses is completely unlimited. If your spouse is not a US citizen, there's a maximum in 2021, I think this has been unchanged for a few years actually, of $159,000. So you can gift your non-citizen spouse $159,000 per year right now. Other exemptions, so charitable organizations don't fall under the 11.7 million, neither do political organizations. There's also an educational exclusion. So if you pay a school directly, you don't have to report that amount. It doesn't have to be under the 15,000. You could pay Harvard, $60,000 direct check to Harvard for someone's tuition, even if it's not for yourself, and that would be an exemption. There's also a medical exclusion. So if you pay a medical facility directly, you don't fall under that. You don't fall under that 11.7 million or the 15,000 per year. Okay, first we're going to talk about gifting to minors. So wealth transfer is usually a goal that we as financial planners have to somehow fit into financial plans, and there's so many different ways that we can gift to minors. One of them would be setting up a Uniform Transfers to Minors Act account for the minor. So even if it's a savings or checking account or investment account, you can set up what's called a UTMA account, where it's that child's money and a custodian will manage it for that child until age of majority, which is 21 years old. Actually, in the state of Washington, we can go up to age 25, but it's going to be state specific. So I'm just talking about Washington today, but that's one way that we can give to a minor. Another way is by setting up a 529 plan. Assets can be placed in a 529 account with the minor as a beneficiary, and these assets must be used for education to avoid taxes and penalties. So it's something definitely to keep in mind there. Pros and cons, we'll talk about all of that. And then a minor Roth IRA I put as kind of another idea. But in this scenario, the minor must have earned income. So we're talking our teenagers, they're minors, they're not quite 18, they can't open a retirement account for themselves yet, but there is, we do have a way to help them out with retirement early. Hey, UTMA accounts. So gifts to a UTMA account are irrevocable. Something to keep in mind. So if you set up an account for your son or daughter who's a minor, and you decide to deposit $10,000, that is their $10,000. No way to take that back. We have to use it for them or for their benefit or keep it in the account for them. So you as a parent can be a custodian, but it doesn't have to be the parent. A custodian is assigned to manage the assets for the minor. It's most usually a parent or grandparent. And then the assets transfer to the minor at age of maturity, which in Washington, we can go up to age 25. The custodian, as I mentioned, has the authority to spend the assets for the benefit of the child, and accounts can hold cash, securities, property, other assets. Most common is probably cash and securities, and the income from the investments can be subject to kiddie tax. So something to keep in mind as well is if we have assets growing in an account for a minor and the assets grow and income is above $2,200 in that year, the child is essentially responsible for that first $2,200, and then it bumps up to the parent's tax bracket. So earnings growth on a UTMA account must be reported each year, and those earnings can fall underneath the the parent's tax bracket and reportable on the under the parent's taxes, whatever their income is. So something important to do, I would say, is just talk with your CPA, talk with your tax advisor before dumping a ton of money into a UTMA account, just to see what that could do, what the tax effect is there. And then financial aid or FAFSA could also be affected by the child-owned asset. So now the child has assets under their own name. When you're applying for financial aid, that could be included and potentially hinder any financial aid for college. Now let's talk about a 529 plan. The investors or their beneficiaries' own state may offer additional state tax benefits for investing in their plan. This is for those of us who don't live in Washington. So Washington, we don't have state taxes, it doesn't matter. But if you lived in Oregon, California, there's an extra benefit to a 529 plan, potentially, extra tax benefit. Oh, I can't read what my own thing says here. Give me just a minute. Oh, okay. And of course, no gift tax for contributions up to $15,000 or $30,000 for a couple. My husband and I have a young daughter, was born in 2018. We can dump 30,000 into an account without having to worry about any kind of reporting. We can also do, which is special to a 529, a 5-year lump sum contribution of the 15,000 each, which is 150,000. So a couple could put 150,000 up front into a 529 plan. There's no income phase out limits, so we don't care about your income. You can contribute no matter what. And there's a deferral of federal taxes on any earnings growth. So that 150,000 turns into 400,000. There's no taxes on the growth as long as it's used for educational spending, which we'll talk about in the next slide. But there's no federal taxes on withdrawals at all, as long as they're used for education. So what type of, what constitutes educational spending? So it's a wide range of expenses. Most accredited colleges and universities are going to fall under a 529 plan, qualified distribution. There are some certified apprenticeships, vocational schools, K through 12 tuition expenses are now included. This is sort of a new thing, up to a certain amount, and even for student loan repayments. So we've sort of broadened the scope on what we can use for a 529 plan. There's no mandatory distribution age. You can keep the account balance indefinitely. So this is often used as an estate planning tool. Even though I promised we weren't going to talk about estate planning, a lot of times grandparents will put money into 529 plans because it will actually remove the assets out of their estate, and they still have the ability to change beneficiaries. So right here, the account owner is able to reassign to another eligible student with no time restriction for making the change. So if my daughter Ruby, if she had a 529 plan funded by myself, let's say, and got a full ride scholarship, my son that's due August 12th, I could essentially change the beneficiary from my daughter to my son, and those assets can now be used for his educational purposes. And then the account owner, which is also known as the custodian, maintains control of the assets. So whoever the custodian is still gets to pick the investments, still gets to be the one to distribute, even though it's out of your estate when you put money into the 529. There's also minimal impact on financial aid. I say depending on the investor situation. We'll get to FAFSA in a little bit, but for the most part, it's probably not going to impact financial aid a whole lot, especially if it's a grandparent-owned 529 plan. There's a wide range of available investments tailored to the risk tolerance, sometimes to the age of the beneficiary. If you have a 401k, you've heard of a target date fund, a fund that says, target date 2050 for retirement. They have a similar setup for 529 plans for investing. But the target date would be the date that the child would go to college. Contributions are also removed from the account owner's taxable estate, even though assets are retained until they're used for education. So once again, they are removed from your taxable estate and thus used for an estate planning tool, which is really nice. So FAFSA, under the new rules, these are brand new rules, grandparent-owned 529 plans will not report the assets on the FAFSA form, and distributions will no longer be reported as student income. So that's kind of a huge change. I will say there's a profile called the College Scholarship Profile, the CSS profile, and so far, this is also a financial aid form. So far, grandparent-owned 529 plans are still considered on this application. So used by about 200 private colleges in the US, probably more internationally, but that form, something to note is that if the child is going to go to a private school, there could be a chance that any financial aid is affected by the 529 plan assets. Okay, and then here at Financial Insights, we use a lot of different planning tools to kind of help advise our clients. I'm showing you an example of one right now. This is my daughter, Ruby. It's her path to a 4-year college degree. I put in her her birthday right here, July 13th, 2018. And then I've used an annual cost assumption for an in-state school. That would be $26,820 per year. And then I've just plugged in an estimate of how much to save each year. So she's already almost 3. If I just now started saving and I saved $5,000 per year, the amount of tax-free growth in the 529 would get me college spending of about $155,760. There's still a shortfall. So I should probably tell family and friends when she has her birthday to please contribute to her 529 plan. And that's something that you can do. So even though a relative or a family member must be the custodian for my daughter, anyone can contribute to her plan. So, family, friends, anybody who wants to, kind of give her a birthday gift, I can tell them you can also dump money into her 529 plan. It would help her out for college. They're going to want to probably make sure it's under that $15,000 per year limit, unless they're being very charitable. Whoops. And this is something that we do for our clients. So if I want to know exactly how much I should probably save for college, I've got that number right here, $7,792 per year should get her all the way through 4 years, fully paid, completely tax-free in a 529 plan. So really a fun tool. I'm just kind of showing you the tip of the iceberg here, but something that we do when we do goals-based planning, just to help our clients with college or anyone who's interested in college planning. Okay, a minor Roth IRA. Rarely used, I have to say, but kind of a fun option. That would be a minor child who has income and wants to start saving for retirement. You might have a little entrepreneur in your family who might find this attractive. The good news is earnings can grow tax-free. It does require an adult to serve as the custodian, of course, because we're talking about a minor. So this is someone who's working prior to being age 18 to open up their own retirement. They also must have earned income, the minor. The age of majority also depends on the state, kind of like the other plans that we talked about, 21 for Washington. The contribution limit for a Roth IRA for a minor is still the $6,000 a year, or the total of the child's earned income, whichever is less. So if they have a lemonade stand, at 16 or whatever the case, they probably have a more sophisticated job at 16 and they only earn $2,000, just that $2,000 can go into the Roth IRA. And there's no tax deduction. So a Roth, just to kind of refresh everyone's memory, no tax deduction when you contribute, but can be completely tax-free when it's withdrawn. Contributions can be withdrawn at any time. However, earnings may be subject to taxes and penalties if the account has not been open for at least 5 years and the owner is not yet 59 and a half upon distribution. So again, this is still a retirement account. There is one exception, which is that $10,000 for the first time home purchase. That exists today. I don't know that it would exist in the future. It's going to change probably year by year as taxes change, but something fun to kind of think about. And then here's the hypothetical growth of a minor Roth. This is assuming a 7% annual rate of return, which is probably not realistic, but let's just play with this. At age 15, if they contribute $3,000 annually, really you're contributing for them because of course they want that $3,000 at age 15 for more important things, new shoes, a bike, whatever the case may be. So you are gifting the $3,000 in this scenario to their Roth IRA. And we do that every year because they have earned income every year. At age 25, they now have $69,000 in their account if it grows at 7%. If we continue that $3,000 annual contribution at age 45, that's over $500,000. So kind of fun to look at, kind of a fun scenario to think about for those little entrepreneurs who are really thinking about their long-term growth. And then let's talk about gifting appreciated assets. So this also applies to minors. but we do have to keep in mind the kiddie tax. So it's not always something we would recommend. But when you gift an appreciated asset, let's say it's a stock for conversational purposes, the cost basis travels. What I mean by cost basis is if I buy a stock for $10 a share and it's now worth $100 a share, my cost that I paid for it is the cost basis, that $10. Say I have one share. And then if I gift that, the recipient, if it's not a charity, because charities are usually exempt from paying any capital gains tax, the recipient is the one who pays the capital gains tax only when they liquidate. So they could hold on to, the stock in this example, but then when they decide to liquidate and disperse the funds, they would have to pay tax. Again, not reported if it's under $15,000 a year per person. $15,000 worth of stock in this example, if that was transferred or gifted. And then of course, keep in mind kiddie tax for minors. So probably wouldn't use this for minors, but there could be a scenario where you'd want to gift some stock to a minor. And then I have an example, which actually came up, I want to say this year or last year, not this exact stock, of course, but we had a client who had a 28-year-old child who was taking a year off to complete her master's degree and had taken a year off from work. So has no income to report at all. And the parents decided to give $30,000, we're saying of jointly owned Microsoft stock, with a cost basis of $1,500. So this couple, they were thinking that they would have to hold on to their stock, they had a very low cost basis, and they thought they'd have to hold on to their stock until they died to get a step up in cost basis because their income is very high. It doesn't make sense to liquidate. They'd rather just pass it on to family and not have to pay any taxes. However, for a couple years, their daughter is not going to be having any income to report, so we can actually start gifting. We gifted $30,000 of the stock. The taxable gain would have been $28,500, and at a 20% tax rate, that's $5,700 that they would have had to pay if they would have liquidated. However, the child got to receive that stock and liquidate to pay zero. So $0 using that strategy of gifting appreciated assets. And again, if we gift appreciated assets to charity, usually charities aren't subject to any kind of tax. Okay, charitable giving. You can gift cash, publicly traded stock, property, private equity, etc. I would say definitely talk with your financial advisor when you want to talk about the best way to gift, because it's going to be a lot. But capital gain property, once again, receives a fair market value deduction and the elimination of capital gains tax if donated to charity. So fair market value, meaning my example of that stock that we bought for $10, but it's now worth $100 per share. $100 per share is going to be the fair market value. So if I gifted that today, the fair market value is $100. And that's what I get to say I have given to charity, even though I only paid $10 for it. So tax deductions, I will say I assist in preparing taxes for clients. And, one of the items when we think about itemizing our deductions, we have cash items and then non-cash items. The standard deduction is $24,800 if you're married filing jointly, and I'm using 2020 numbers. But for 2020, individuals could deduct $300 from gross income, even when using the standard deduction. So that could be, if you gave $300 to charity, that's above and beyond the standard deduction. And actually for 2021, it should be $300 per person. So it was $300 per return. It should be $300 per person, total of $600. So, so definitely keep your receipts if you gift to charity, even if you can't itemize, because you're going to want to report that. It's above and beyond the standard deduction. And then there was a temporary suspension in 2020 of limits on qualified charitable contributions. Typically, or I have a number at 60% of adjusted gross income. And if you want to know what type of organization, if you want to find the deductibility status for the organization that you're giving to, it's typically 60% or 30%. I would just go to irs.gov, do a tax exempt organization search, and you should be able to find out, exactly what your organization has allotted to. And then non-cash items. So typically what I see is clients just taking a bunch of stuff to Goodwill. There's no 2020 temporary suspension, so everything has stayed the same for non-cash items. You can deduct the fair market value of the property. I would definitely suggest that that property is carefully accounted for. Maybe not so much the Goodwill t-shirts, if it's just $100 here or there, but if it's any large item, especially over $500, there's some extra forms the IRS needs. Sometimes I know some CPAs use pictures of items. So keep careful accounting if you decide to gift a large item. And then the deductibility limitation is typically 50 or 30% for those items. So next we'll talk about IRA gifting to charity after age 70 and a half. This is kind of a funny year for us as financial planners. Because the RMD age changed to 72. That's your required minimum distribution. So everyone who has a traditional IRA or 401k, or actually Roth 401k, even though it's not taxable, needs to take a required minimum distribution every single year starting at age 72, meaning you have to withdraw that money and then pay tax on it. But you could do a qualified charitable distribution of up to 100,000, and then for each person, so additional 100,000 for a spouse, and not have it count as income. So money goes directly from your traditional IRA, as an example, to a qualified charity, and none of that distribution is reported as income, and that can start at age 70 and a half. So you don't have to wait until age 72. We're still using the old required minimum distribution age of 70 and a half to use a QCD for our clients. It's also excluded from tax formulas for Medicare premiums. So even if you pulled out $200,000 to give to charity, that $200,000 doesn't show up anywhere in your income, including the income that's used for your tax formula for Medicare premiums. It must be a qualified charity, so definitely look into that first. And it must distribute directly from the retirement account to charity. I will just tell you, it has happened countless times as a financial advisor where I sit down with a client, maybe to start working on their taxes from last year, and I find out they don't ever use the required minimum distribution. We've been sending it to them to their bank account or to a check, and they immediately turn around and give half of it away to charity. If we would have known that, we could have gotten a lot more money to that charity because we could have distributed directly from the IRA to the charity. The recipient doesn't take possession of that money at all, and there's no taxes that are paid, and it reduces your overall income. So if there's one strategy just to kind of remember, just have in the back of your mind, should I call my advisor? It's definitely the gifting to charity after you hit age 70 and a half. Also, an inherited IRA can be eligible for a QCD as long as the beneficiary is 70 and a half. So if I inherited an IRA right now, I would not be able to use this strategy. But if you are 70 and a half and you inherit an IRA, you could also use a qualified charitable distribution. And then I say, ask your financial insights advisor about our tax planning tool. Please do. I get very excited about this tool. And here it is. Okay, I was worried it was in a different spot. So we have something, and you're not seeing the full tool, of course, but we have something that we can use just to estimate how much you could save in taxes by using QCDs or qualified charitable distributions. Here's a sample client. And this is just to give you some context because it's not in here. He's got about a $1.5 million IRA, wants to gift maybe $15,000 each year to charity. Using a QCD, that would save him his estimated lifetime tax savings of $110,000. That's pretty cool just by using this strategy. And then, of course, here's the taxes that he pays without the strategy. So pays a little bit more in taxes without using that strategy. And this tool also maps out, you know, if you wanted to get really crazy year by year, how much you would pay in taxes and what type of accounts you have. The different tax brackets are here. So we can get a little crazy. And I don't mean to confuse anybody, but basically what I want you to take home is that we have a tool. If you're thinking in your mind that you wanted to use QCDs, please let us play around with our tax planning software. It's going to be very fun for us to do so. Okay. Gifting assets at a loss is rarely done, but I did have it, you know, kind of on the slide because every once in a while, if you have assets that are automatically stepped down at death, so this would be the opposite of my stock example. Let's say we bought a stock at $100 per share, but today it's worth $10 per share. Maybe we're towards, you know, the end of our life, and we really don't want that loss to go to waste. If something were to happen to me, now that cost basis gets a step down, you might gift that asset at a loss to preserve the loss. So losses are used for many different financial planning you know, strategies, but basically used to offset gains and up to $3,000 annually against ordinary income. So if I knew that my stock was going to go to my daughter and I knew that or my spouse, and I knew that was going to have a step down, I might start gifting that that asset at a loss instead of just letting it be stepped down. Okay, and Roth conversions. This is again more of an end of life tool, but I would call it a gifting strategy because you are gifting tax-free money eventually. So a Roth conversion allows you to pay taxes now under your income, potentially reducing your estate due to the tax bill, due to you cutting a check to the IRS, as well as allowing your beneficiaries to inherit tax-free assets. And of course, there's potentially, you know, the 10-year rule if it's not a spouse, but the strategy, you know, for those of us who have very large traditional IRA assets, the strategy is I can convert, that's what a Roth conversion is, convert part or all of my traditional IRA into a Roth. That's now whatever dollar amount I convert, let's say it's 30,000, that's now 30,000 of income I need to report to the IRS and pay taxes on. And then once it's in the Roth, it follows the Roth IRA rules. So essentially tax-free upon withdrawal for my beneficiaries. You have to still follow the Roth IRA rules for tax and penalty-free distributions. So let's say I do a Roth conversion and now I want to actually access that money. I need to make sure that my Roth has been, you know, that conversion is at least 5 years old. Otherwise, I'm going to have a penalty. So something to think about. You still have to follow the Roth IRA rules. But again, this is more for, you know, for passing on the money. I wouldn't suggest it, you know, as a strategy. Other than that, unless we were doing Roth conversions, you know, more earlier in life, this is really just kind of talking about a later in life strategy for gifting. And then Roth IRAs also avoid required minimum distributions unless it's a Roth 401k. Again, the Roth 401k, it's not going to be taxed, but if you have a Roth 401k, I just thought I would add that as a sidebar, talk about converting that to a Roth IRA so that you aren't subject to a required minimum distribution every year. And then inherited Roth IRAs are subject to a 10-year rule as of right now. So if I were to inherit a Roth IRA, let's say from my grandparent, I have 10 years, even though that money is completely tax-free because it's inherited, and the taxes have already been paid, I have 10 years to withdraw the funds out of that account. So I can't keep them in there forever for tax-free growth, unfortunately. And then citations. So we covered a lot. Of course, I always talk faster than I think I will. So let me just open it up to questions. Let me see everyone's faces. Okay. And then I guess I'll just pass it on to Katie. Do you have any questions for me? Has anyone said anything yet?
Everybody feel free to either unmute in the top right box of your, where you see yourself or see a picture that you've put in there, or toggle with your mouse down below till the chat little box pops up, click on that and type your question in.
Hey, Amanda. Hi. Bev Cox.
Hi.
Hi. Good job. Good job. A lot of information.
Thank you.
Right.
That was great.
My question was on the step down, the capital loss idea, and you had mentioned your daughter, and I think that's what threw me. Because in order to claim that loss, if I gift that stock that's not worth it, I have to give it to a charity, right? I can't like gift it to my kid and take that loss.
Well, right, you wouldn't be the one taking the loss, correct? If you gift it to your kid is the one that gets to take the loss.
Okay, but you could actually gift it to your kid as opposed to gifting it to it, because it's wasted on a charity, isn't it?
Right, exactly. Yeah,
Yeah.
I don't see how it worked with a charity. But yeah, it would only be if you wanted to gift it for someone else to be able to use the loss.
Right, right. Okay, great.
Okay, what do you consider a large IRA to decide when to gift from it?
What do I consider a
That
large?
was me, Amanda. I had heard you say, if you have a very large IRA, and I was kind of wondering at what point would you want to start gifting out of a retirement account?
Yes. Well, and I would say, and I hate to do this as a financial planner, but I would say we would have to run a financial analysis because it depends on what we're doing with the gifting. Are we gifting to charity? Are we using a qualified charitable distribution? How old are we, when we have, because we have, in order to do a withdrawal, we at least have to be 59 and a half. So something to think about there. But a lot of times, I would say your IRA is too large when we project your required minimum distributions at age 72 and you're not going to spend that money. If we project your required minimum distributions and that'll be income that you'll have to pay tax on, and we've decided that that makes your overall income way more than what you plan on spending at that time, I would say your IRA is probably too large and we should talk about different strategies for how to reduce that.
Okay.
We've got a couple from Doug.
Different for everyone.
Do you see it, Amanda?
Oh, no. Let me see.
Okay, so it says if charity, all and give the proceeds and use the loss, sell. So I think he meant if charity, sell and give the proceeds and use the loss. And then in your QCD example, you said 100,000 per person, but isn't it 100,000 per IRA owner?
Sorry, yes. Yep, 100,000 per IRA owner is correct. Everything he said is correct. Yeah. Person and IRA owner, I guess I am using as the same thing, but thank you for clarifying.
Any other questions? Oh, I have one.
Sure.
So you said at the beginning that, okay, so for example, okay, I'm putting myself out here again, Bev. I'm going to be vulnerable. So you had said that gifting like things, right? I have a couple collections, not to brag, okay? Don't be jealous, everybody. But I have like a really cool 60s through the 90s toy collection of vintage toys. And I also have a very cool collection of original first copy records on vinyl. So with that said, my intention is to gift to my 3 kids, meaning my 2 biological and my soon-to-be son-in-law. What type of advice can you give to someone like me to make sure? Oh, and I also have a vintage car, an antique car that I'm going to be gifting to my son, to the Fairlane. So with that said, any advice with regards to how or anything I should know, since it's a material thing and not cash or a
Right.
stock or?
Right. When are you planning on giving these assets?
Good question. So I am going to be giving him the Fairlane, probably because it's a lot. She's a lot to drive. So probably before I pass away, definitely it's going to be probably I'm 50, probably in the next 15 to 20 years tops. And I'm also going to pass down my Fiat, because she'll be a little collectible because they don't make them anymore, the one I have, to Mackenzie. And then the toys, before also, most of these things that I mentioned will be before I pass away, because I want them to enjoy it while I'm alive, and I want them to come in and, yeah.
Yeah, of course. Well, I would say first of all, don't try and get cute with the IRS. Okay. Don't try and sell it for $1 and think that, it's not a gift. That's the first mistake I would say that, some people try and do. Oh, I didn't gift it, I sold it and it was worth $1. No, it has to be worth a fair market value, if you're going to sell it to avoid the gift. But from everything I'm hearing, I mean, you should be able to structure these gifts, especially in different years, so that, it's not a big deal. It would just really go against your lifetime gift exemption. So there shouldn't be any tax due. That's 11.7 million.
Yeah, we're not going to have to worry about that.
Very few of us are this lucky to have that problem. But what I would say is just keep your accounting if you can.
Okay.
Just don't open yourself up for, an audit. Nobody wants that.
Right.
The IRS just wants to see, just clear records of especially how much you purchased everything for, maybe even the dates if you have that.
Okay.
And then just keep that. That will help your kids. Yeah.
I also have pieces of art I thought of too. So yeah.
Yeah.
Cool. Thank you.
Mm-hmm.
Any other questions? Oh, we do. Oh, no, there's, thank you. Okay. Thank you, Amanda and team.
Perfect.
You're welcome, Doug.
Welcome. Well, if there isn't any other questions, just wanted to thank Amanda for speaking today. And if a question comes up while I'm speaking, which sometimes happens, feel free to put it in the chat bar. Oops, that's not what we wanted to do. Sorry about that. Was trying to just share with you, let's see if this works a little better. Okay, there we go. So you should see Wisdom with Women up on your screen.
No.
You don't.
Yes.
Wait.
Okay, well, I apparently tech-wise am not very talented. You should see Deb and Teresa.
There we go.
Yay. Perfect. Okay, so thank you all for joining the fifth Wisdom with Women. Our sixth is going to be, just wanted to give you a heads up, July 22nd, we'll be with Teresa Harbottle and Deb Morris. Locally, they own a company called Evergreen Elder Concierge, which helps seniors with concierge style services, which is such a need right now between fraud, baby boomers not having children in the area or not having children at all and starting to age, having someone there to assist in bill pay and really just about everything. What they really come into your house and help with all sorts of things. We have a lot of clients that use them. Either way, they're coming to speak about the age of fraud and why seniors are more vulnerable to financial scams. This is one of the most important sessions that we've seen in a while from an external speaker. I think will be really valuable. So July 22nd, watch your inbox and Facebook and LinkedIn and all of that for that. And join us. And Amanda, thank you so much for speaking with us.
Thank you.
The session will be recorded. And if you have any questions for Amanda, or if you'd like to speak with Amanda about anything she talked about, I'm sure she would love to speak with you post-session. We will send out both the recording as well as Amanda's contact information for you in the event that you want to connect.
Cool.
So great.
Have a great day, everybody.
Have a great day, everybody.
Thank you
Bye.
for joining us. Bye.
Thank you. Thank you.
Welcome.